this week. We're
No, well, here we go.
You're listening to This Week in Real Estate with your host, Rob Golfi. Brought to you by the Golfi Team at RE/MAX Escarpment, featuring Conrad Zurini, broker-owner of RE/MAX Escarpment Realty Inc., and Brian Hogben, owner of Mission 35 Mortgages. Let's hear what's going on in real estate this week.
Good morning, everyone. My name is Phil Golfi, guest host for my dad, Rob Golfi. He's away on vacation this week. Welcome back to another episode of This Week in Real Estate. We got Mission 35 broker owner Brian Hogben, RE/MAX Escarpment broker of record owner Conrad Zurini. How's it going, gentlemen?
Good. Just fighting off interest rates as much as we can. You know what I mean? Trying to beat them up with a bat right now, but not easy to do with inflation rate numbers that come out like that the other day. So you guys see that one? Inflation rate came out at 6.8% the other day. I was like, oh,
yeah, 6.8. Yeah.
So I guess we'll hop right into it. What's been your messaging to your teams, to your clients, to your team members in terms of where their headspace is at and what's going on? Because we're going through this enormous swing, a pivoting market in terms of the opposite that we went through at the beginning of COVID when we were climbing and there was that price appreciation, rapid growth. And it was like everyone had this feeling like, I need to get into the market because the next house is going to go for $20,000 more, $30,000 more. And now we're sliding and it's like, okay, I don't want to buy yet because I'm going to wait for it to hit the bottom. So Brian, I'll start with you. What's been your messaging to your team and your clients?
Yeah, it's great. And I think Conrad would say the same. It's really about education right now because you got to teach people what everything means. A big conversation in our world right now is, are rates going to go up to meet 10%? Should I lock into a fixed rate now before it gets out of control? And I think, we're telling our team to tell our clients, like, listen, it may be right for you, but you need to know what it means. And locking into a fix, there's typically about three things that you got to consider. Number one, there's a massive penalty if you break a fixed mortgage. And the reality is that the average person only makes it to 3.5 years of a 5-year term, right? So, you get death, you get divorce, you get job change, you move. So you're paying a massive penalty to break a fix versus a 3-month interest penalty on a variable. The second thing is you're going to end up like your payment's going to go up astronomically on a fixed, right? You're building in that increased payment already just for like sleep insurance, right? So that's not necessarily the best thing to do, right? And the last one is the downside. There's a great article that just came out from Benjamin Taub. I know, Conrad, you see him a lot too. He's a CIBC guy. But basically, when we see rates and we see markets like this, if you lock into a fixed, you're guaranteeing that you're paying a high rate for the next 5 years. There's likely going to be a downside on this as well, too. The downside might be in 18 months. It might be in 2 years. It might be in 6 months, right? But there's always a correction typically when this happens. So if you lock into a fixed rate, you're going to miss that correction, right? So I think we're educating people right now, just like talk to somebody, know your options. Don't make any hasty decisions like locking in a mortgage or doing something that you're not prepared for, and go through the numbers, go through the budget, go through estimates. If it does go up a quarter point, if it does go up a half a point, if it does go up 3/4, can you afford it? And I think, I think the worst thing we can do is just say, yeah, don't worry about it. And we see lots of people saying, don't worry about it. It's like, no, there is a concern. Just be educated on what it is.
Conrad, what about you? What's the message to the team right now and the message to their clients?
Well, I think there's two groups of people that have a huge opportunity now. I think there's those people that, number one, that were trying to enter the market back in, back early this year and just got priced out of the market. And we're seeing prices back. Sometimes we're only seeing them back, January. Some areas we're seeing them back to like December prices. So again, this is an opportunity for people to get in, which is great. The other people are that if they have 3 years left or 4 years left on their mortgage and they want to move up, perfect opportunity to slide into this market. When you're seeing the inventories the way they were. We were begging for inventory back in January, knowing that this was happening. This is still, I'll say this, it's still a supply and demand story because there's a lot of supply out there, coupled with what's going on with interest rates. But I'll say this is a great opportunity to jump in. I think you can save money right now. I think I think most people still got about 4.25, probably another 45 days in them at 4.25. Would you say, Brian, 60 days?
I think it's just shy of 60 right now. Yeah,
just shy of 60. So those people, like, think about this. Some product, especially move up, they could be saving 15%. And I'll tell you something. This is interesting. I've been following it very closely already. So the big factors I look at all the time is the sales to listing ratio, sales to new listing. We're seeing like Bronte having it much higher. We're seeing East Burlington much higher than everyone else. So it's still, we're seeing it creeping up to be back to a seller's market. So it's saying that 70% of the stuff is selling. In East Burlington, 70% of the new listings are selling. So that's where we're in seller's territory. And there are some areas where we're seeing leveling off. Like I would say areas like Vineland, Jordan, prices have leveled off. And I even saw 2-story in Ancaster in the month of May up 1.6%. So some areas we might have hit the bottom, and I find it kind of carries all the way through. And again, Fort Erie's probably got the worst in terms of it's a real buyer's market because there's a lot of inventory. People are they're holding on to price, right? And I think if you've got a great product in a great area, you'll always do well. And I don't have to tell you that, Phil. You know that better than anybody. That's I call it the cream puff factor. A cream puff house and a cream puff location, you'll always do well. And we're seeing multiple offers. And I will say this, month of May, this is the other thing. 66% of the listings sold in Hamilton, went 100% or over in the month of May. Boom.
Unbelievable. And so it just shows you in terms of how much the media can control the confidence in terms of the buyers that are looking right now, and also the sellers, right? And I feel like there's in my opinion, there's been some buying confidence that has been taken out of the market. And working with a few buyers on my end, it's like, 2.5 months ago, there would be 24 offers, 25 offers, and you couldn't wait to go line up and put your 25th offer in. Now, there's deals out there, there's opportunities. You can go through the house 3 or 4 times. You can have a negotiation and include a condition of finance and a condition of home inspection, but there's still that hesitancy to move forward and proceed due to a lack of confidence. And it's 100% directly correlated to what we're seeing in the media. And go ahead, Conrad.
No, I was going to say this. I don't know. Did any of you guys see Top Gun Maverick?
Yeah.
No. Well, what was the line? What was the line all the time? Here we go. That was sidebar here. No, but what was the line? Don't overthink it. Don't overthink it. And I'm telling you, that's what's happening out there. Look, COVID came. People ruled they made decisions with their emotions, and it carried them through. Look, listen, we only have a few pleasures in life, and a roof over our head is one of the main things of sustenance and how we live. Right. And again, COVID, we didn't know what direction it was going to go to. People, they ruled with their heart. And I'm telling you, if you need to get into the market or want to get into the market, go with your heart on this. I'm telling you, all the other fundamentals are there. Immigration, no supply. There's panic for no reason. I'm telling you, go with your emotions on this. You won't fail.
And I think too, we're seeing the investors start to sniff around and dip back into, because I think the investors took a probably 60-day hiatus, and now they're like, you know what? I'm going to start dipping back in now. So we've got a lot of first-time investors that sat on the fence that really wanted to buy a property before, decided not to because to put in unconditional as your first-time investor. Now they're like, I can buy an investment property now, put in a condition of finance, and you actually get a home inspection. I'm going to start looking again. Yeah. And I know, when you start following the money like that, well, that starts to eat up more supply again, and that starts to push the market forward again too.
Big time. And not only that, I'll piggyback off that, the details matter so much more now. Any real estate investor in the last 2 years has made money no matter what you bought, no matter what you were working on.
I know.
And we always use that term, the accidental millionaire. That's what it's been. That's what it's been the last 2 years. But now we're seeing the details matter so much more, even from a selling perspective. I mean, when we were pricing homes, I would walk into a homeowner and they say, how much do you think my home is worth? I said, I have no idea right now, but I'm going to put you in the best position to sell and make you the most amount of money. And this is how you do it. Now we're back to a traditional balanced market. Pricing homes efficiently has become a proven skill to be a good agent to price the home right and to attract buyers. We're back in that style of market, which is important. I wanted to bring up this article by Desjardins, and they talked about some of the smaller communities in Ontario and being the big swing communities, such as the Bancrofts. They came out and said Bancroft might plummet 185% in terms of an average price point, right? And I think, which is unbelievable, but they highlighted a few other small communities. It's going to be interesting to see what happens with those communities that were, lack of better terms, untapped, got a whole bunch of influx of buyers and skyrocketed. Now these articles are coming out and saying they're going the other way. Where do you think the bottom is in terms of prices, even just around the Hamilton area? And what do you think is going to happen with some of these smaller communities?
Well, I think it's the work, like how work is going to shape out. We're talking about 5 years before we really have something like back to pre-pandemic office levels, and we may never even see that. So again, it depends on people in particular. I'm not arguing that point, but what we are seeing is people that have in Bancroft decide to live there and raise their families, and if they work in Toronto, they're buying a condo with a coworker or something along that line. So they've got the best of both worlds happening. Maybe they were hoping they would take all that equity they made in Toronto and put in the bank, but now they're figuring out that I have to hedge my bet in terms of when I have to go into work. So yeah, like theoretically, yeah, I could see. I don't see 185%, not a chance. But then you got to remember all these people that are going to be retiring shortly. Like it's going to be the numbers of boomers that are going to be retiring over the next 5, 10, 15 years is going to be staggering. And I think that you can't belittle the demand those outskirts are going to have, because people like to retire in those areas. But like I just said to you before, think about the border of Oakville and Burlington, and that we're seeing it's almost going to a seller's market, because people are saying, I'm going to put my flag in, I'm going to decide where I'm going to live. This is how I'm going to commute. I'm going to commute to Toronto 3 days a week, and I think this is I'm going to hedge my bets on where my employment's going to be, and I'm going to do that, and I'm going to be close to the Niagara area to play, and I'm going to work in Toronto. Look, we're poised right now in our area for people really giving us a really good look at the opportunities in Hamilton, Burlington, and a bit of that Grimsby, Beamsville area. We're poised for some phenomenal growth here.
Excellent. Awesome. Brian, what do you think in terms of the price depreciation and how that, is affected by the interest rate hikes right now?
I think I think it's an excellent opportunity, right? And I think these are all moments in time. And I think people have to remember that the market can often be wrong, right? Like there's a lot of indications on the market. And I remember Tiff Macklem, he was talking about interest rates in July 2020, saying, we're not going to increase rates forever. Right? Like to that extent, saying they're going to stay low. And now here we are 2 years later. And he's like, we're going to increase rates forever. Like, it's like, you just have to take all this stuff with a grain of salt and realize it's a moment in time. And I think for these smaller markets, 180% price decrease, as an investor, I wouldn't let that happen. I'd go in and probably prop up the market. If I saw a big drop like that, I'd probably want to invest there. And I think other people have sat on the sidelines too, like we were talking about before, and they're going to choose to invest their money in these areas. And I think what Conrad said too, it's all about emotion too. Most people will buy a house and stay in a house and live in a house for 5, 10, 15 years, right? And if you're I think some people made some rash decisions, but a lot of people they're going to adjust with the market. If they have to move, they're going to move, but I don't think it's going to have a massive impact on the price. Yeah. I don't think that is in my take.
Yeah. It's just going to be interesting to see how it plays out. There's so many, I guess missing variables right now as we kind of go through this little time that we have. And I always look back, I go, it was inevitable. We talked about this happening. We knew that we were coming to the end of a runaway market, a price appreciation growth market. Are you surprised that they warned us about the interest rate hikes? That's all we talked about. Interest rate hikes are coming. Interest rate hikes are coming. And then now we're here. And it's like, this is it. So I always think back. It's like, people, will reflect on the 5 or 10% that they've lost in the last, quarter, but they don't want to look at the 35% they gained in the last 2 years. And that's the best way to put it.
They'll forget it all. And look, if you want to took a crisis proportional time in Canada, it was the 90s. Like, we had a huge run up in the 80s in terms of prices. Between 90 and 95, we lost probably somewhere between 30 and 40% in terms of value. But when you apply it to today, well, so what? We're going to be back to what, 2020 prices? Like, so again, 20% was in the first quarter. Like, really, if we get back to August pricing, maybe that's the floor, August 2021. I don't think it's terrible. Look at people that bought 5 years ago and look at the appreciation they have. It's amazing. Look, there was a frenzy. People got in. As long as you're, again, look, real estate's a great product, right? We all know it. We all make a living on it. The stock market's, you can see it. We're going to a bear market. We're going to see growth will be very, very small. To try to get back some of those gains over the next couple of years. But real estate's always seemed to outperform. So again, we've got a blip here. I feel for the people that bought during this market, during the frenzy, but it'll catch up. They'll be fine in a short period of time.
Yeah. And I think just to add on that, the wealth factor for Canadians is huge in equity. And they may have lost a little, but if you actually look at the average of Canada, the average mortgage on a house is under 35%. Like, you take all the homeowners that are mortgage free, you take all the people that have owned for 10, 15, 20 years. So, and I know like there are some people that get stuck here, but that is a lot of wealth sitting in Canadians' homes. So for that to dip by 10% or 15 up or down, it doesn't really have a change in lifestyle for those people, right? Yeah. It's just the emotion of the moment right now.
Yeah. And you go back to people that bought in 2017 in that frenzy and ask them, they're very thankful that they bought, because look where they are now. Yeah. And that was only, 6 or 7 years ago. So it's going to turn around very quickly here. And I think, home ownership's a top priority amongst young Canadians. And we're still going to have those people entering into the market.
And maybe we have to admit the stress test was a good thing.
Yeah.
Right.
Yeah. I don't want to go, Conrad. I'm not gonna
go. One last question though. Is it time to turn that around and retool that? Because now our qualifying rate, what's our qualifying rate with the stress test?
It's all over the map now. It depends on your 5-year contract rate. Like, your stress test rate is going anywhere from 5.5 to 6 up to 8% in some cases. It depends. Right. Like, it does need to be amended for sure, and I think you'll see that happen very soon.
Right. Yeah. Awesome. We'll leave it there. Another good show, guys. Thanks for joining me. I think I'll be back on next week. My dad's still away for a little bit here.
Cool.
So We'll see you guys next week and we'll chat then. Thanks again.
Okay.
Have a
good
day.
Okay.